Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thanks everyone for joining us. So today is episode number 36 with Randy. He's going to introduce himself in a minute. So for those who are new here, our focus tonight is going to be how to get from 0 to 1 from a passive investor's perspective. Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. So we're going to do some introductions now. So again, thanks everyone for joining. My name is Marcelo Cazini. I'm here in Houston, Texas, and my background is in IT and software development. And I'm a local CCIM member here in Houston with all the CCIM designation trainings. I'm also a multifamily investor, and I operate my own commercial real estate. And I've done single family fix and flips in the past before getting to multifamily.
Marcelo, are you a big A&M football fan?
I am, yes. I'm excited.
Just saw tonight's news that Jimbo Fisher just got his contract extended for another 5 years.
Yeah, at a good pay
$9 million a year.
Yep. Yeah, I'm excited for the season to start.
It's a lot of money.
Oh,
he's on your investor list, right, Marcelo?
Exactly, yeah. I keep in touch with him regularly.
Okay, guys, this is Claudia Rubio. I am an architect. That's my background, but mostly asset management from Colombia, South America, where I was born. We are here in Houston. We've been living here in Houston for 8 years. We started multifamily a little bit more than 3 years ago, and we already have a couple properties under management that we syndicated here in Houston. And I also have a National Apartment Association certification that's called IROP. And yeah, that's it.
And I'm Marcelo Rubio. I have a background on consulting, mostly on IT, cybersecurity consulting for around 26 years. Our background based on that is mostly on business management and asset management, and that's how we got started in multifamily. Right now we have around, I think this is outdated, we have around 1,200 units that we invested as LPs and GPs, and we have around 500 units that we have syndicated here in Houston.
All right. So Randy, do you want to go ahead and introduce yourself?
Well, thanks for the opportunity. Randy Langenderfer, as it says there, my LLC is called InvestArc Properties. That's the name, but I'm a transplant to the great state of Texas from Ohio, where I grew up and spent a majority of my life in both the Northeast and the Northwest part of Ohio. And as the slide shows there, I have undergraduate degrees in accounting and information systems. I do have an MBA in finance and a CPA, though. I'm a CPA and resume member only. That would never sign a financial statement these days, anything. But I'm currently employed as at the Baylor College of Medicine here in Houston. That's what brought me here about almost 9 years ago. So I've been here almost 9 years in January. Been invested in multifamily since 2014, as it says. You got the GP, KP there in about 250 doors, LP and several thousand doors. Really enjoy multifamily. Spend a lot of time doing it, and I hope to retire from the corporate world in the not too distant future and do this full time.
Awesome, Randy. Let's get started. First question is the basic question. When you started in real estate, was multifamily your first step, or if not, or if yes, why multifamily?
Well, and I would echo what Marcelo said. Please ask questions. This will be a lot more enjoyable than hearing me drone on for an hour or so. But my journey got started. I mentioned I relocated to Houston from the Cleveland, Ohio market, where I was living for the previous decade or so prior to coming to Houston. And the short answer is I was a single family hard money lender to a group that we had become acquainted with out of Dade County, Miami area. We had a brother-in-law and I had formed an LLC, and we were hard money lenders. We were flipping houses in South Florida, had done many. I came to Houston for business purposes. As I said, I went to, I was let down here without my family for about 4 months. And so I went to every real estate meeting I could find in Houston when I got here, north, south, east, west. It was before meetups had really taken off, but there's still a bunch of real estate investment groups. Went to all those. I landed at Lifestyles. I went to Lifestyles Expo, and I landed at Lifestyles, and I had attended their weekend 2-day seminar. They do single family one day and multifamily the next, if you've ever been there. Mm-hmm. And I was very intrigued with multifamily, being a single family guy at that time. And I attended their expo, and I heard a guy by the name of Brad Sumrock speak there. And I was not real impressed with Lifestyles. I mean, for an investment perspective, you had to join their preferred investment group or the PIG group and pay $25,000 or $30,000 now to even see deals. Mm-hmm. But I went to the Sumrock group. I spent about 3.5 years there. I really learned many of the intricacies of process, underwriting, team building, etc. Started doing investing there. Today, I'm a coach in the Rod Khleif's organization and part of his mastermind as well. So that's the short answer, I guess.
All right, that's awesome.
Awesome. So when you were starting, you had some background on real estate with single family. How did you get the education to start to get to your first passive investment in multifamily, like everything that you consider would be needed, or did you just jump in the water, just learning while you went, or how do you approach that education?
Yeah, everybody in the meetup here has probably had that experience at one time, the aha moment or whatever it was, when the light bulb comes on or whatever you want to call it. Why? But for me, it was sitting at the Lifestyles Expo and hearing Brad Sumrock talk about being able to buy a multi-million-dollar asset with a non-recourse note. So as a finance risk adverse, generally speaking, kind of person, I had looked at buying businesses. I had looked at buying franchises before coming to Houston, et cetera. And all of them, you sign personally. And at that season of my life, I wasn't willing to gamble everything I had acquired, which I'm not independently wealthy, but the concept of non-recourse debt just floored me. And I sat there and I went through the same, it was a Lifestyles conference, but this was early on when Brad was still in good terms with them, or they were speaking. And I sat through all 3 sessions repeat to listen to the session again and again, because I'm a slow learner. And there was that concept of non-recourse debt that really was the aha moment for me. You know, I have back here at Tombstone for my first property, I still look at it and I say, somebody loaned me $4.5 million. Anyhow, you can get a multifamily loan easier than you can get a single family house loan, most generally speaking, because they're non-recourse.
Yeah. So at that time you decided, okay, I want to syndicate, or you said, okay, I wanna become just a passive investor for now and learn more? How did you do that?
Like most people, I was, again, my day job is in the corporate governance, the risk areas. And so I say that I'm in compliance, privacy, IT security, and audit services. And so I always talk about it from a risk perspective. What's our risk tolerance? And so I would always look at this like, am I joining some cult here? Is this like just a bunch of really sick people, or I mean, to throw money around like they're multimillionaires? So I went to it with a very skeptical, analytical mindset, and I just kept attending and kept networking and kept listening. And my first deal was through the Sumrock organization, and it was when I did the first one. And I think I don't know how much in depth you want me to go about that one, but the first deal was in the Sumrock organization. And, it's like everybody that always talks about what was the challenge. Well, for me, the challenge was writing that first check, right?
First $50,000.
For $50,000. And, even though you do it electronically these days, you don't really sign. My fingers were shaking on the keyboard because I had wondered if I had done something really dumb. But that was the first step. So it's networking, it's education, it's developing your strategy, your investment strategy. So then versus now, very different the way I look at deals, obviously 7 years later. Got a ton of different ramifications or a ton of different things to consider.
So how long do you think, I don't know if you had like an analysis process on how to choose which one to go into, or did you just trusted the sponsors? And how long did it take you to get to that first passive investment since you went to that lifestyle event?
Well, I moved down here in January of 13. I didn't find it was the spring of 14 before I really got into real estate and started going to the Sumrock group. And I would say it was in the summer or the early fall of 14. I could go back and look, is when I bought my first deal. And so, like many people, I didn't understand the analytics as well as I do today, but it was really a relationship with, I won't never mention the person's name because you know him, who I invested with, because I knew him, I liked him, and I trusted him, right? And so there's the key. If people always invest with somebody they know, like, or trust. And I had connected with this individual because he was a corporate guy. He was a seasoned corporate guy, but yet an entrepreneurial at heart, and had done a lot of tech startups and that stuff. And he seemed to have a very good property that I was intrigued in. So that was the first deal, 2014.
Cool.
Which I can talk another hour about because actually it's the subject of another podcast. If you want to look at my website, you can hear the whole story. A Dan Hanford podcast, because it really, the short answer is the first property, what I learned was I now understand, I did not understand then, was bought on a bridge loan. It was a 225, this was back in 2014 when bridge loans weren't popular. And it was a 225 unit property in Port Arthur, Texas, that had been, a developer had bought it from the city. It had sat abandoned for a number of years, and the developer had bought it and really redone the whole complex. New roofs, siding, really did a bang up job. It was about 65% occupancy when we bought it. And the play is a true value add play, just lease it up, refinance it, take a bunch of money out, and milk that cow. 2014, 2015, we did that. We leased it up, refinanced it, got 60% of our money back.
Wow.
And I'm thinking I'm a pretty smart individual here, and I was thinking that we had really done well, 9-10 months into it, and got 60%. No, it was 18 months. I'm sorry, 18 months. I got 60% of my money back. Well, so that story is a long one, but I'll try to condense it. Followed by fraud by the property manager, followed by a fire on the property, followed by deaths related to that, and then COVID. And finally, we sold it in early 20, just about the time COVID was really coming about. So I owned it 6 years, and we got all of our money back. I didn't make any money, didn't lose any money. We got all of our principal back. So you have an opportunity loss for 6 years. But there are so many stories to tell in that investment. That one, if I were to show you my portfolio today, is the worst performing. The best performing was a 4x equity multiplier in about 22 months. The one that we syndicated and did a 1.95 equity multiplier in 21 months. So I would say for those who are new to it, I have a story to tell there about that one. But over the last 6.5, I did this about a year ago, 6.5 years, my portfolio has turned a 2.2 equity multiplier, or 120%, however you prefer to look at it. So for every dollar I've invested, I've gotten $2.20 back. And from an investment perspective, I'll take that kind of return all day.
Yeah.
Much better than, even if the stock market is crazy this year, last year, as we know, but the multifamily is not going to be up and down like that. It's going to be much more straight.
Yeah.
So,
Yeah. Awesome.
go ahead, Marcelo.
And so throughout all these deals that you've seen, breaking even, making a lot of money on particular ones, what would you tell somebody who is starting now and they're looking to invest on their first deal? What would be your best advice for them?
Well, the simple illustration that I think it resonates most with me, and it's not original with me, but I use the story a lot, is it's the story of the horse and the jockey. So in a horse race, there's a horse and there's a jockey, and which one of them is the most important? And so in the multifamily space, the jockey is the syndicator or the general partner, and the horse is the submarket, or where the asset is located, what it's about. So I would always encourage, and as I talk to students today through Khalif organization, I always say it's the GP or the jockey in that illustration that's the most important. Get to know the syndicator, the general partners. I'm just going to pause there. Get to know them, understand their history, understand their success. Maybe they're the first time syndicator. That's not bad. Where did they get their education from? Was it from one of the national groups, or did they get it through online? What are their returns? I mean, there's a whole list of questions you can ask them. I can send you some I've got if you're interested afterwards, if you send me an email or something, but there's a lot of different ones. But you want to understand, what's their philosophy? Are they buying and hold for 7 to 10 years? Are they going to flip it after 5? Is it a yield play? Is it a value add play, or a hybrid? Any one of those strategies. I was listening to Neil Bawa, who's another famous guy, and he's talking about, he's in all these Class A properties, brand new development. Well, his return is going to be very different than somebody looking at, the Port Arthur deal I was looking at, and it's a lot less risk because it's brand new. So there's a lot of things to consider, but the first one is the sponsor, and then the second one is that horse in that example. Get to know the property, the submarket. Where is it at? Different syndicators tend to specialize in different areas. When I came to Texas, people said, Port Arthur, you invested in Port Arthur? I didn't know any better. I invested in another property up in Greenspoint. I didn't know Greenspoint. I know it now. I know Port Arthur now. I would tell people not to invest in Port Arthur. But there's still can be money made there. So it's know the sponsor, know the market. There are a lot of hot markets today: DFW, Houston, San Antonio, Austin, Phoenix, Atlanta. Those are the Carolinas. I mean, those are all very growth oriented, high income, high population growth, the two indicators you'd look for as well. You're going to lower your risk by looking at areas that are high growth, population growth, and high income growth. That's why everybody's attracted to Texas as we look out there. So happy to answer any questions on that. I can go on for.
No, absolutely. And one of the areas that we typically get a lot of questions from people starting is, I got a deal presented to me. A lot of times you're getting, maybe as you start getting into lists and meeting people, you may get 2 or 3 deals at the same time. Do you underwrite deals yourself? What are you looking when you're underwriting the deals? Talk to us about your underwriting process, if you will, and you mentioned a few indicators that you look at. From an underwriting perspective, how do you look into
from an underwriter perspective? I guess I think I make a better general partner because of my LP experience, and I tend to always have that background. So and again, people tend to have one syndicator or different objectives there. But when I underwrite properties today, we start with the ideal property would have a 7 to 9% annual cash on cash return, have an IRR, internal rate of return, of around 14% or better, and return a total equity multiplier of 1.8 or better over a 5-year planned hold. So 7 to 9% cash on cash, 14% IRR, and a 1.8 equity multiplier over 5 years. I can tell you, and everybody knows on this phone that's ever done it on this call, that's hard to come by these days. That's very hard to come by. So we're underwriting a lot. We have been unsuccessful to date in 21, but we continue to underwrite a lot. But we start with that, and there are tools and templates out there. I mean, Brad's got a great tool and a template. The other big educational groups also have different various tools that they sell. And to me, I think it's going back to getting to know that sponsor. You can, if you want to pay big money, you can go to Lifestyles, join their preferred investment group, their PIG group, and they do all this for you. And they just send you pre-approved deals. Brad's group, you don't have to be, at least I don't know since I've been gone, but you don't have to be one of his personal students to invest. But he also reviews deals and kind of sanctions them. Is that, I see Claudia still shaking her head. Is that still what the Sumrock group does?
Mm-hmm. Yeah, for his coaches. Yeah.
So there's a risk mitigation for the new investor is going to one of those groups. You're gonna meet tons of people there. They're gonna have a process that is designed with the passive investor in mind to kind of protect them. But still, that doesn't mean, I'll say with all due respect, Brad's group sanctioned my Port Arthur deal 7 years ago. It's still a business, right?
Yeah.
And things can happen contrary to what everybody tells you. To quote Mike Becker, another good mentor friend is, trees don't grow to the sky. Someday they stop growing.
Absolutely. And when you look into a deal that, again, a passive syndicator is presenting to you, you're considering investing, do you look into, again, just on the underwriting part, do you look at what they're doing with expenses, what they're doing with the revenue? I mean, are they being too aggressive, decreasing expenses? I mean, are there certain things that people are telling you that they're going to do with the revenue in terms of increase that that's probably not going to happen? I mean, what are your thoughts on revenue increases that syndicator tell you, or maybe expenses decrease that maybe it doesn't pan out?
So I think that's specific again to the sponsor and different geographic areas. But I think, yes, when I put on my LP hat and I get approached to invest in a deal, and I still think limited partnerships, passive investors is really, I will invest in other people's deals as long as I've got money. Because I'm really haven't found an asset class that I think is better from the tax advantage, from the forced appreciation and the cash flow perspective. So let me pause there. I always used to look at buying dividend paying stocks. Well, multifamily, if it's paying, is going to knock that out of the water as on a preferred basis. So I tend to gravitate towards people that I said before that are corporate people, because I think that brings a little bit of sophistication and maturity. That doesn't mean I've invested with a lot of different types. As an LP, I get solicited a lot now, because when you do one, you get on multiple lists. And so the criteria becomes very different. So I look very much at the sponsor. I've got a couple key sponsors that I've got 2 or 3 or 4 deals with that I repeat invest with. So I've known, liked, and trust them, and they have a property record. If you're a first timer, yes, you should ask a lot of questions. Get them on a call. If there's a WebEx, make a call afterwards, get on the call and ask them questions. Yes. What are you, well, first of all, why do they like the market? That's probably presented in the WebEx. Why do they like this asset? But I pause and I say, I've been in a lot of WebExes, And for you have been there too, have you ever heard a syndicator say, we underwrite very aggressively?
Absolutely.
Nobody will ever say that.
Mhm.
Everybody always says we underwrite conservatively, very conservatively. And, it's followed by, and I always ask myself, what does that mean? Because one person's definition of conservative is another person's definition of moderate or aggressive. You mentioned rent growth. So, finance people always overestimate expenses and underestimate revenue. If you're a syndicator, you want to bump the returns up, you know that you can manipulate those projections or pro formas pretty easily in the spreadsheet. So yes, what are the rent growth numbers? What are the expense growth? And oh, by the way, all the rent growth numbers have been thrown out the window this year, because you used to say 3-4% rent growth, and most markets are seeing 5+ this year. With many markets seeing 10% rent growth. So there's an anomaly this year that we don't know if it's going to stick or not. So if somebody would have presented me a deal with 10% rent growth last year, I'd have laughed at them. But now when you look at some of the rent bumps people are getting, and there just seems to be no end in sight, it's caution, but you have to look at the analysis of what the comps are for that area. So it's a rent growth, it's the expense growth. I ask questions around, what are your other assumptions? Like, what are your reversion cap rates? Your syndicators should have that in their sensitivity analysis in their deck. So that greatly affects returns. That's, the reversion cap rate is, you're buying it at X cap rate, and when you sell it 5 years from now, the cap rate's going to imply what the value is, and that's not going to be what it is today. I just had this call with one of my partners the other night saying that, what's it mean in that range? Well, conservatism, I would say, means that you're projecting an increase in cap rates over a 5-year period. There are a lot of people out there showing this future sale value based upon a reversion cap rate that is equal to or less than the buying cap rate. And that greatly affects the return.
And do you see other areas of revenue that syndicators are telling you that they're going to have, other than, you mentioned rent growth and you mentioned cap rate, but do you see other sources of revenue?
The other income line is certainly worth pursuing. As rent growth people started looking at, adding more amenities. So even my own underwriting, we try to put in, internet packages and things like that, the value add you're going to add. So how is the other income going to be generated? That's much with the property business plan. So are they going to put carports in it? Are they going to add valet trash services, internet services, dog parks, interior room, what's their CapEx plan? That certainly tells you what they're going to do with the property. So rent growth, expense growth, reversion cap rates, what's the capital expenditure plan? Insurance, the other big one today, and obviously we know in Texas, all the properties in Texas are getting killed by insurance. The number of brokers out there or the underwriters have exited the market because of all the losses they incurred with the freeze and previous catastrophes. So there's fewer number of underwriters out there. And I remember we underwrote that Port Arthur deal in 2014 at what we thought was an extraordinary high price of $300 a door. And it sat 1.5 miles off the ocean. Today, that same property, it probably cost you $2,000 a door. I don't know. We generally underwrite in most, the Houston market at a minimum of $800 a door today, start on insurance. So that just shows you. The other thing you got to look at is, I think you got to challenge the assumptions around payroll cost. I think you're going to see with inflation, salaries continue to rise. So what kind of projection does payroll cost project in the pro forma or the underwriting? So you can get into a whole lot of analysis, or you can just say, I trust Randy, or I trust Martin and Claudia, and I'm just going to invest with them. they've got a good track record, a good history, or anybody else along the way. So you can take the technical analysis, or you can take the relationship side of it. I think the good investor takes both.
Yep.
And looks at it and says, I like Martin and Claudia, and they've got a great property in a great area, and they've got a good business plan. Boom, I'll write a $50,000 check.
100.
Make it 100.
Well, there's another one. So there's a. I'm sorry to interrupt you. Go ahead, Claudia.
No.
I was gonna say we come from a very skeptical environment like Colombia, so doing business is way more difficult. And I think that approach of having that relationship with the people and knowing them, we always feel like it's necessary that you complement it with having your own analysis. And I'm not saying don't trust anyone, but even though you like and know people in Colombia, it could be even your family. You'll have your due diligence to make sure that's actually true. So that's what we also recommend to everyone.
Yeah, trust but verify, right?
There you go.
Exactly.
Well, another one I was going to add is, so when I first got in, again, I was risk averse, and I didn't even want to put a $50,000 check in. Actually, my first check was a $25,000 check. I split. I found somebody to partner with on the investment, and so there are ways to get around. You may say, I don't have $50,000 of disposable income, Randy. Well, there are ways to get around that. Trust. You can use I still use my self-directed IRA today, where I invest from. A lot of my passive investments are through my self-directed IRA, a great tool. So you may not think you don't have 50,000 laying around, but between your self-directed IRA and your friends and your relationships built within one of those large educational groups, it's doable.
Yeah. So I wanted to ask you, if you look back to that first deal, what would you have done differently? Now, with what you know today, what things you will be able to change if you change?
There is, good question. I think today I am, and it's very popular, but I am skeptical of bridge debt, though it's a very different market today than it was in 2014. What I would have done differently is I would have challenged the underwriting much more than I did at the time. I would have looked, there's one we didn't even talk about, I mentioned one of the things that went wrong was the management company. So ask the syndicators their relationship with the property management company, assuming they're using third parties. Have they worked with that property management company before? Does that property manager have experience in that submarket? Person we put out there didn't have any experience in Port Arthur at all. And do they have experience in that class of assets? So if you're in the Houston, you may have people that have Houston experience, but maybe they got all Class A new development experience. Mm-hmm. Well, they're probably not the best third-party management company for a Class C or B- asset. Ask the sponsor that. Ask them their relationship. Why do they like company X? And they should be able to tell you that. So the biggest ones I would have underwrote it differently. I would have had the caution hand with bridge debt at the time, and I also realized in retrospect this particular friend syndicator that wrote this deal, it was a CMBS loan, so it wasn't an agency loan. So for those CMBS are big insurance companies also lend money to multifamily buyers, much like Fannie Mae and Freddie Mac. And he convinced me you never want to use a CMBS loan too, because the loan covenant agreements are much more onerous than they are for an agency debt loan. And when this asset started going south, they basically sweep all the cash and they take total control of the property. And that was also one of the downfalls in that one. But
how do you see differently the bridge loans back then and the bridges right now, which is pretty much what everyone's going to?
Yeah, and so back then it wasn't as common. Martin, it was very unusual. And the only reason, I mean, that one he got bridge debt because it only had a 65% occupancy. And there was nobody going to lend them that money for 225 doors. So, but, I subsequently realized, right, there's another big one for you as a passive investor, a new investor. What kind of debt are they putting around it? Are they putting agency debt on it? Well, you guys know that if you're going to do agency debt, you got to have a 90% occupancy. So there's much less risk in a property that has a 90, 95, 99% occupancy than one that has 60 or 65%, right?
Absolutely.
So the CMBS requirements for the higher interest rates and stuff. Today, you fast forward, there's so many bridge loans, and I really predict that the agencies are going to start getting much more aggressive in 22 around it. But the terms are better. They have automatic renewable clauses in them for the most part. For the advantage of bridge debt is there's no prepayment penalty, so that can have a large impact on the return. And it also makes it much more sellable, that a buyer wouldn't have to assume your existing agency debt. So there are a lot of advantages to bridge today, a lot of advantages, and you just have to make sure you get a credible one.
Yeah, I think a lot of people are scared of loan bridges because they have the reputation that they used to be exclusively for distressed properties, like you said, low occupancy or big construction ahead, things like that. And because of that risk, the interest rate difference between agency and bridge was at least 100 basis points, right? And nowadays with the low interest rates out there, bridges are so inexpensive. I think there's probably 30, 40 basis points different with agencies. That I think that's why it became so interesting. And the agencies, I think I agree with you. They're gonna start getting more aggressive next year because this year I'm sure they're not making the numbers they were making a year or two ago, right?
Yeah. I think that's logical. And there's a lot of, traditionally bridge has gotten a bad reputation because there were bridge lenders out there with the loan to own philosophy. So they would lend you money and then put all kinds of constraints on you using money on the rehab and things like that. And they would then, some loan to own, they would take the property over. They would declare you in technical default of the loan and take the property over. I don't hear of that as much. And I think if you're going through the right brokers or the right people to get your bridge loans, there's a lot of quality bridge lenders out there today versus the unscrupulous type.
Yeah.
Randy, going back to the analysis, when you are analyzing a deal for you to invest in, what are the deal killers or red flags that you would say make you say, I'm not going to invest or even look at it?
Today I still gravitate a lot towards people in the Sumrock group. I get solicited by them a lot. So I have great comfort in their educational mindset, their underwriting, I would say conservatism, even though I'm not in the group today. But deal killers for me like you guys, I'm sure you're on listen. I used to say I get one a month. I think I get 2 a week now. It seems like everything is for sale in Houston and Dallas and San Antonio. Having said that, so the deal killers for me are one, location. Well, the first deal killer is just available resources. Do I have money to actually invest? Because it's sooner or later you become tapped out of your personal finances. Second one is geographic location. So I get deal killers all the time. Not that deal killers, I get deals, I'll say Boise, Idaho, Salt Lake City. I've heard good things about Salt Lake City, but I don't know enough about it to invest. So I would say available funds, the geographic location, and then I start to drill down. So I kind of have my, what's the capital stack like? So there is many different models out there, and Brad's group is all still 80-20, but that's becoming more difficult to find Many of them are 70-30 equity splits. So for those, that means 70% of the ownership is from the to the passive investor, and the other 80% are in the 80-20 model, 80%. And so you see 80-20 with no pref, you see 70-30 with a pref, and then a lot of them are putting in another layer of preferred capital stack in there that's a stated rate of interest only. I've seen them as low as 50-50 splits.
Wow.
And why anybody would do that, I have no idea. But I know of one guy that does that. So the capital stack, I still like to see. I really encourage, and everybody on his phone, when you get in your first deal, that's the other thing to do, is read the legal documents. Read the PPM and the operating agreements. So I myself, I like to find properties. It's getting harder to, and this one is where the syndicator gives the LPs a voting right.
Mm-hmm.
There's a lot of deals today where the syndicators, the LP has no voting rights at all. And the best one I've seen is where they have a voting rights on a refinance or a disposition, a sale. And so I advise new syndicators, so why wouldn't you want to do that? It just makes you look more, well, we don't want to have to chase down all the investors. Well, if it's a 70-30 or an 80-20 model, you got 20% of the vote already. All you got to do is find 30% to go along with you.
Yeah.
And do it. It's not like you have to have 100%. You only have, most of them are written 51% of the investors.
Mm-hmm.
So the capital stack, the voting rights, I encourage everybody to look at the capital call requirements in the documents. Mm-hmm. So what are the capital call requirements? In the rear, I've never been on one where there's a capital call, but if there is a capital call, there are, if you read the language, you can see a lot of diversity. Some says that if you don't contribute to the capital call, your capital is wiped out. Others will say that your capital is diluted by whoever.
Yeah.
So, but until you read the docs, you don't know. What's the history of fees of the syndicator? So fees, and my favorite one recently is when you get involved in a lot of these, what's the sponsor's experience in creating a K1 at the end of the year? My pet peeve, I'll say the best one I've ever seen is Mike Becker's group. He's got, I don't know, 10,000 units or something like that. His K1s come out at the end of every February. And so I still want to be an April tax filer. And you see a lot of sponsors that never get their K1s out. You have to always file an extension on your returns because you're waiting on some sponsor to get you the K1. So that's actually risen in my hierarchy. So I'm looking down at my notes. Capital stack, voting rights, capital call, K1 history, and fees are be the screening I'd put them through.
So what are your, so in talking in terms of fees, do you have anything pro or against? I mean, all the different fees that we're seeing now, I mean, acquisition fees, disposition fees, refinance fees, and
waterfalls.
Yeah.
That's a great question. So I talk a lot about this in some podcasts, but I'd say there are models that are investor friendly models, and there are models that are sponsor friendly models. And so I always try to coach and encourage people to find what you want. So a sponsor friendly model, I have people tell me, do you really care, Randy, if they're returning 100% of your investment? Do you really care how much they're making as long as you're getting your 100%? No, but I will say versus the sponsor who's got a 70-30 with a 7% pref and a second layer of pref in there, preferred equity, where they're paying 10 or 11%. And then there's acquisition fees, asset management fees, refinance fees. There's fees for, I'm sorry, the distribution changes from 70-30 to something else if an IRR hurdle is met. The back end waterfalls. So nothing's wrong with those, but I just really encourage investors, especially the new passivists, to think about those and what's your comfort level. I've done in deals where there's been back end waterfalls, very few I might add, but I still gravitate towards the Sunrock 80/20 model with no pref and no waterfalls, just a straight equity 80/20 split. It's simple. I can get my head around it versus some of these really complex models being established today. The best one I've ever found, I got involved in I talk about investor friendly. So one spectrum is someplace with all the fees in the back end. They still may be returning something, but think how much more money you'd make if they had a more different split. The best one I've ever seen is a 90/10 split with a 9% pref.
Well,
Wow.
So those
Wow.
two extremes, just think of those as an investor, the two extremes there.
Yeah.
I would label one very investor friendly and other is sponsor friendly.
Mm-hmm. Mm-hmm. Awesome. Great answers. And I wanted to ask you, now that we're talking about reading documents, what do you like to see on the investor reports, on the monthly reports?
Well, I would
What
say
are
that
you used to see? What do you like to see?
what I tell you, it's easier what I don't like to see. And this is and I'm another person from the Sunrock Group who's kind of coached me on it. I don't like to see a syndicator who sends out an email with go sign into the portal and read it. So I say attach the report to the email and I can always sign into the portal if I want it, but don't, just as a pure convenience. So once you get many of these, you're looking for the ease. That's why I talk about K1s. I want to do my taxes. I want to see the summary documents quickly. So that'd be first one. In there, I mean, I still like the entire package. So I like there's an executive summary with the corresponding income statement and balance sheet, cash flows, rent rolls. If I was so inclined, I could use that to ask questions. So the reality is the majority of investors never look at that stuff at all until there's something that angers them or they get disgruntled with. When I had that property in Port Arthur where there were some disgruntled people and everybody was, I was on the call a lot with the sponsorship group, but use the information. You don't need to be a pest, but you can ask probing questions. You can ask probing questions and that shouldn't be viewed. And if a sponsor, I would say I've invested with several sponsors and I make the decision that I will never invest with them again. Not because they returned very healthy profits, but just their business philosophy and how they handle their communications,
Yeah, there's definitely a lot of sponsors that don't understand the concept of a return investor, right? I mean, that's always harder for you to acquire a brand new investor than just to cater to your own investor pool. So there's a lot that seems like once you sign the check, that's the last you're going to see from them. But there's definitely the good ones that will keep that communication open and the good reporting throughout the entire deal process.
So I was, one example of that was I was looking at an investment for a guy out of the Chicago area that you guys probably know as well. And I consider myself kind of experienced and I made a call with him. I listened to the pitch and I made a call with him and he was very short with me. He didn't want to answer my questions and it seemed like I was bothering him. Giant red flag for me and I did not invest. And maybe he was just busy. Maybe he was, I don't know, maybe he had a, emergency in his family or something, but he didn't tell me that. It just seemed very short. The other side of that is when I was the sponsor for another Beaumont property that I did, we had a fire in it. Rather than sending out an email to everybody, I got on the phone and I called our investor groups personally, to talk to them and brief them about it. So they heard it. Maybe it's because I'm a baby boomer and that's the way I was taught, but so there's just different communication styles and,
Absolutely.
there are others that I got one investor that he doesn't want to talk to me. He just wants me to text him. Okay.
Yeah. Well, I wanted to ask you about markets, both on the passive side and on the syndicating side. what kind of markets are you focusing now that we know that you're not looking at Port Arthur?
Well, and that's not to say that there's still not money to be made in Port Arthur, because you can make money anywhere if you buy right. I just became a little jaded. So even if any of your audience here likes Port Arthur, that's not a criticism of Port Arthur. I talked about Beaumont. People told me I was crazy for going to Beaumont for my first GP, but we made a lot of money and we just bought really well and managed well. So that can be done. But I mean, today, as a GP, I'm focusing on Houston and San Antonio markets primarily, and then tertiary markets within Texas as they come up. Waco, I've looked at several in Longview, some of those, Beaumont. I still like Beaumont. Many people don't. That's Beaumont's Port Arthur for many people.
Yeah.
And then there are other sponsors that I know that, so a lot of people have gravitated towards the Atlanta market. I have not invested in the Atlanta market yet, but I know that's a very, it's a very population growth, two big indicators of population growth and income growth to support all the things that people are doing there. Phoenix, another really hot market, tremendous population growth, tremendous job growth. You look at the Charlotte areas, the Jacksonville, the Tampa's, those areas, that just, I happened to be listening to, I mentioned Neil Bawa the other night, and he made he said a number that just really floored me. The reason a lot of those markets are so hot is he said, and I haven't been able to verify it, but he said of all the money in our currency today, in the US, 40% of it has been printed in the last 12 months. 40% of all of our currency has been printed in the last 12 months in the US. And that's an astonishing number. That's why the capital markets are so flush with cash, and everybody's looking for yield in return.
Absolutely.
Yeah.
So since going through COVID and the scrambles that we had last year and still not being out of it now, are you looking at multifamily differently? Have you changed any parameters on your looking to invest on a deal that maybe you weren't thinking before, and now that we went through COVID and you've seen how your properties behaved, how do you look at properties now versus before COVID?
I think like all of us, we were all scared to death last spring, April, May, about what was going to happen and when Armageddon was going to happen on the multifamily. But the reality is my portfolio, and most people I've talked to, if you're in those markets, the Texas and those growth-oriented markets, they've actually fared pretty well. Yes, there's some deadbeats, but primarily occupancy is still in the mid to high 90s rate. And on a large scale, that's very good. How I look at them differently, though, I think I'm probably a little more liberal in some of my assumptions when I underwrite and when I'm even a passive investor. I was just looking at one recently, and they were talking about potentially 9% rent growth. Well, I would have turned off the video if I heard that a year ago. But in some markets, this in particular, great sponsor, great history, good track record, comps support it. I actually got closed out of the deal as a passive investor because it filled up so quickly. So the market is telling that sponsor that his assumptions are okay. So I think some of those rent growths we talked about, I have talked about, depending upon, as I underwrite properties today, what the reversion cap rate is. The rule of thumb used to be 15 basis points a year. Well, depending on the market, I think that's probably too much. And I think it's going to be stable. I don't see, a 5% cap or 100% basis points growth in cap rates in the next 5 years. It's possible, but my last year have taught me that there's so much money in the market today, as we just talked about, that these properties are going to appreciate just by holding them. If you do nothing, the inflation, that's why it's such a good investment deal.
Absolutely.
You don't have to be the best syndicator or the best brainchild in this market to make money.
Yeah, for sure. So I do want to remind everyone that's new here that we do have a YouTube channel that I posted on the chat before, and I'm posting it again. So we always post every meeting that we have there. So if you want to go back and rewatch some of our previous episodes in case you missed one, so please subscribe to that. And we always meet on the first Wednesday of the month now. And so if you want to join us again, October 6th is going to be our next meeting. So please tell your friends. We like to keep this group small so we can have a conversation. So this is a little bit different than other meetings, but we started online and we are going to continue online. So hopefully we'll see you again on October 6th. And I wanted to share Randy's information again. So if you need to contact Randy, here's his info. And with that, I just want to thank you, Randy, for joining us. We appreciate you spending the time with us tonight. We learned a lot. And
Great conversation, Randy. We can stay here forever, listening to you and talking to you. Thank you.
Well, appreciate that. I'm happy to do it. And I just wanted to address, there's one question there from Mark, talks about who do I use for SDIRA. I have an account, two accounts actually, one at Quest in Houston and one at Equity Trust Corporation in Cleveland, Ohio. Happy to talk about it. Send me a note. I'd also put, there's a web page out there for me. It's invest-arc, just like you see in the email, the invest-arc.com is my web page. And you can schedule, if you want to talk about anything else, you can schedule some time there, or click on my newsletter if you want to stay in touch. Love to talk to you.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.